Have you ever felt like investing is all about finding that one in a million company? You know, that single magic stock that's just going to take off? Well, today we're going to talk about a totally revolutionary idea that says maybe you don't have to do that at all. We're going to dive into the simple but incredibly powerful idea behind index funds.
This one quote from the legend himself, John Bogle, pretty much sums up the entire philosophy we're talking about today. It's an idea that's so simple, it seems almost too obvious now. But it was a thought that would completely turn the world of finance on its head by asking a simple question. What if the goal isn't to be the best, but to just capture the power of the whole thing?
So to really get why buying the haystack was so radical, we have to go back and understand the problem it was trying to solve. For decades, investing really meant one thing, setting off on what many people now see as a totally impossible search.
Right, so the old school approach was all about active management. You'd hire these super smart, very expensive professionals to analyze companies, predict what's next, and handpick the stocks they thought would crush the competition. Their entire job was to find that one little needle in the giant haystack. But then, a really important question started bubbling up. Were they actually finding it? And the data? Well, it's just staggering. Look at this. Over a 10-year stretch, 84% of professional fund managers in the US failed to beat the market average. In Europe, it was even worse, at 91%, and in Canada, a whopping 93%. The evidence became undeniable. I mean, if the pros, the people paid big bucks to do this all day, can't consistently find the needle, what hope does the average person have? This realization led to such a beautiful, elegant solution. If trying to pick the winners is basically a loser's game, why even play? Why not just change the rules completely? Why not just buy the whole haystack?
And this timeline, it tells an incredible underdog story. After a quiet start in the background, John Bogle decided to bring this idea to everyday people in 1976. And on its first day, it was a complete and utter flop. The IPO was seen as a massive failure. From that tiny $11 million seed, it grew into one of the largest funds on the planet, holding over $1 trillion today. Just an amazing story.
The financial establishment at the time, they hated it. They absolutely hated it. The whole idea of willingly accepting average returns was just settling. Critics literally called it un-American, a recipe for mediocrity. They just couldn't wrap their heads around why anyone would choose not to play the game of trying to be number one. They just didn't get it.
So how does this whole thing actually work in practice? How do you really buy the haystack? Well, the mechanics are surprisingly simple.
Okay, so first up, you need a scorecard. A market index, like the S&P 500 that everyone talks about, isn't something you can actually buy. It's just a list, a theoretical portfolio that keeps track of how a piece of the market is doing, in this case, 500 of the biggest companies in the US. It just tells you if the market is up or down.
An index fund, then, is the actual tool that makes this idea real. It's a fund that simply buys all the stocks on that list in the exact same proportions as the index itself. There's no genius stock picker involved, no guesswork. The fund's only job is to copy the index's performance, which, by the way, makes it way, way cheaper.
And you know, this haystack comes in all sorts of shapes and sizes. You can buy index funds that track stocks or bonds. You can get them as a traditional mutual fund or as an ETF that trades all day like a stock. You can even pick your haystack, one made of huge, stable companies or one made of smaller, riskier ones. But the core idea is always the same.
So what's the catch? What's the trade-off here? Well, on the one hand, you get incredibly low costs, you're instantly diversified, and it's super simple. You always know exactly what you own. But on the other hand, by definition, you can never beat the market average. You are guaranteed to get the market's return, for better or for worse. If the whole market tanks, your fund is going right down with it.
And that simple trade-off, giving up that tiny chance of beating the market for much lower costs and guaranteed market returns, it didn't just create a new type of fund. It sparked a multi-trillion-dollar revolution that has totally changed the game of investing.
And here it is, the historic moment. For the very first time in early 2025, the total amount of money sitting in passive index funds in the United States officially became bigger than all the money in those old-school active funds. The un-American idea had finally become the main event in the biggest market in the world. And this chart shows how we got there. It's not just new money choosing passive. Get this, investors have actively pulled $1 trillion out of active funds over the last decade, and at the same time poured a staggering $8 trillion into index funds. This is one of the biggest, quietest shifts of money in modern financial history. And to put a final number on it, the total global value of index funds is now over $25 trillion. That's trillion with a T. What began as a failed IPO for an $11 million fund has morphed into a global financial juggernaut.
So what fueled this absolutely explosive growth? Well, it really boils down to two main things. First, and this is the big one, investors just got smarter about the high fees they were paying and flocked to the cheaper index funds. And second, some really smart regulations made it way easier and less expensive for companies to launch new index funds, especially ETFs.
But here's where it gets interesting. As index funds have grown from this small, niche idea into the biggest player in the room, the idea of simple investing is starting to get a little more complicated. And it's raising some fascinating new questions for the future.
Yeah, the line between passive and active is definitely starting to blur. We're now seeing this rise of what you could call quasi-active funds. So instead of just buying the 500 biggest companies, a fund might track an index of only the 100 most profitable ones, or maybe only companies that meet certain ethical standards. All of a sudden, the goal isn't just to match the market, it's to try and beat the market, but using these passive, rules-based strategies.
And there's another really fascinating twist. For the longest time, when you owned an index fund, the huge fund manager, think Vanguard or BlackRock, voted your shares for you. But as these firms became the biggest shareholders in basically every major company, people started worrying about all that concentrated power. So now, a new trend called voting choice is starting to give that power back to you, the individual investor.
And this leads us to our big final question. As these massive index funds become the largest owners of pretty much every major company out there, who should actually control their incredible influence? Should it be the handful of people who manage the funds, or should it be the millions of everyday investors whose money it actually is? The simple idea of just buying the haystack has created this whole new world of power and responsibility, and how we answer that question, well, that's going to shape the future of investing for everyone.